Snap stock? Is it flashing a massive buy signal after its latest surge, or are you looking at the ultimate value trap in, a long-term falling trend?
Yeah, that is the million-dollar question right now. Or, well, an $8.7 billion question, I guess.
Exactly. When you pull up the ticker today,
Mm-hmm.
you are confronted with one of the most polarizing setups in the entire tech sector. I mean, it is wild out there.
Oh, absolutely. The market is completely torn on this one.
Right. So today we are unpacking the absolute latest data on Snap Inc., ticker symbol SNAP, as of April 13, 2026. We are tearing into the hard financials, breaking down the technical charts, dissecting this massive bull versus bear debate happening on Wall Street, and outlining the upcoming catalyst.
There's a lot to cover for sure.
There really is. And hey, before we dive in, make sure you like the video, subscribe to our YouTube channel, and leave your comments and feedback below. I mean, if you love deep dives like this, it's basically compulsory at this point, right?
Right. Definitely do that. And before we dig into the mechanics of the standoff, let's set our standard parameters. This deep dive is an exploration of market data, structural financial indicators, and analyst perspectives.
We're just looking at the landscape.
Exactly. We are analyzing the underlying logic driving these price movements. It is absolutely not financial advice. You must do your own research and, understand your own risk tolerance before interacting with these markets.
Always. Okay, let's jump straight into the immediate reality of the price action. Because as of the close on Monday, April 13th, 2026, Snap closed at $5.15.
Which was quite a day.
Right. For the day, that represents a massive surge of plus 6.85%. I mean, it was an incredibly strong day for momentum traders holding the stock.
It was, but you have to contextualize that single day of green against the broader devastation of the chart.
Oh, for sure. It is rebounding from a brutal 52-week low of $3.81.
Oh.
And it remains heavily depressed compared to its 2025 highs, where the 52-week high was sitting all the way up at $10.41.
Yeah, it's less than half of that now.
Exactly. So we're looking at a company with a market cap sitting right around $8.7 billion today, which, I mean, that's a fascinating, almost dangerous size for a tech company in 2026.
It really is. It's too big to be ignored, but small enough to be deeply vulnerable to macroeconomic shifts.
Right. So to understand why the market is pricing in such extreme vulnerability, we really have to look under the hood. We need to see how much cash the engine is actually burning or generating.
Exactly. We have to separate the company's external narrative from its actual financial mechanics. Let's look at the full year 2025 income statement. Total revenue for FY 2025 came in at $5.93 billion.
Okay, so that's what, an 11% year-over-year top-line growth?
Right, 11%. And in the context of the explosive hypergrowth era of the early 2020s, 11% is deeply subdued. It's just not what investors used to expect from social media.
Yeah, that hypergrowth is totally gone.
But the critical metric here isn't the top line. It's what management managed to do with the bottom line. They actually narrowed their net loss significantly, posting a loss of $460.5 million.
Wait, down from what?
Down from a devastating $698 million loss in 2024.
Oh, wow. Okay, so a massive improvement.
Yes. But you have to understand the mechanics of narrowing a net loss by over $200 million while only growing revenue by 11%.
Oh, okay.
That does not come from explosive viral user expansion.
No, of course not. That is the direct result of a ruthless, managed decline in operating expenses. I mean, they are optimizing for basic survival.
Exactly. Freezing headcount, optimizing server loads, slashing experimental divisions. They're doing whatever they can just to stop the bleeding.
And that relentless optimization is showing up vividly in their gross margin, right? Because it's sitting at a very healthy 59% as of Q4 2025.
Yeah, 59% is solid.
Right. And that tells us something fundamental about their core product, the underlying business model, the mechanical delivery of algorithmic advertisements and services to end users. It possesses genuine profitability before all the massive corporate overhead kicks in.
Right, the unit economics actually work. They know how to serve an ad efficiently. Exactly.
Yeah.
But the fact that their diluted earnings per share over the trailing 12 months is still negative 27 cents, I mean, that proves the rot is happening further down the income statement.
Oh, absolutely. They are generating cash at the unit level, but completely incinerating it at the corporate level.
Yeah, so the market is hyper-focused on how they are managing that cash burn. What do the cash flow numbers look like?
Well, operating cash flow for 2025 climbed to $656 million, up from $413 million the year prior. But more importantly, free cash flow jumped to $437 million.
Wow. Wait, what was it in 2024?
Just $219 million. They effectively doubled their free cash flow in 12 months.
That's huge because in a high interest rate environment, I mean, free cash flow is basically the only metric that buys a struggling tech company actual runway, you know?
Yeah.
It gives them operational optionality.
Exactly. But, and this is big, but let's look closely at the mechanics of that free cash flow because the math reveals a massive structural compromise.
Okay, lay it on me.
Operating cash flow hit $656 million, but free cash flow is $437 million. That means their capital expenditures, the money they are actually reinvesting into infrastructure, new data centers, physical technology, is barely over $200 million.
Yikes. For a company whose entire future narrative relies on pioneering augmented reality hardware and deploying like these highly complex compute-heavy AI lenses,
Exactly. That CapEx number is staggeringly low.
it feels like they are intentionally starving their own long-term innovation just to pump up the short-term cash flow number, like just to keep their lenders from panicking.
That is exactly what's happening, and it's how a structural debt anchor warps a company's operating logic. When we look at the balance sheet, the constraints become painfully obvious.
Okay, let's unpack this because they have a good chunk of change in the bank, right?
They do. They're holding $2.9 billion in cash and marketable securities.
Right, but stacked against that liquidity is the baggage. They're carrying a crushing $4.14 billion in total debt.
Exactly. Compare that to their total equity of just $2.28 billion.
So you are looking at a debt-to-equity ratio of 181.6%.
Yeah, it's brutal. In an era where the cost of borrowing has fundamentally shifted upwards, debt of that magnitude stops being a useful financial tool and becomes an existential threat to the business model.
It reminds me of, it's like a homeowner who just got a great raise at work.
Right, the free cash flow.
Yeah, the cash flow is better, you're making more money day to day,
Yeah.
but you are still completely drowning in an underwater mortgage. That massive debt cloud is still hovering over everything you do.
That's a perfect analogy, because if that debt is a structural anchor, then their $2.9 billion in cash is basically a mirage.
Exactly. They can't aggressively deploy that capital to acquire smaller competitors or fund massive multi-year R&D moonshots. I mean, they have creditors watching their every move.
Right. Their primary fiduciary responsibility right now is servicing that debt, which forces them into a purely defensive posture. And this is an industry that brutally punishes defensive companies.
It really does. Having established that Snap's fundamentals are this weird mix of improving cash flow and terrifying debt, let's look at how traders are reacting to this exact tension on the charts.
Yeah, the technical analysis here is basically the visualization of this exact psychological tension. Let's look at the mechanics of where the buying and selling pressure actually lives.
Okay.
Down below, we have immediate buy and support levels at $4.79. That specific price point is a key Fibonacci pivot.
And for anyone listening, in modern markets, that isn't just some subjective line drawn on a chart.
No, not at all. It is a mathematical level where automated algorithmic trading programs are actively calibrated to initiate buy orders. It acts as a programmatic safety net.
Right. And below that?
Below that, you have the absolute floor, the major 52-week support down at $3.81. If the price breaks below $3.81, the algorithmic safety nets vanish, and you trigger cascading stop-loss orders from retail traders.
Which causes the floor to completely fall out.
Exactly. On the upside, resistance levels sit at $5.50 and then way up at $7.34, which is where the 200-day moving average acts as a massive institutional ceiling.
Okay, so when we look at the short-term momentum indicators interacting with those levels, I mean, the market is pricing in absolute ambiguity.
Total hesitation.
Yeah. Following this recent 6.85% bounce, the short-term bias is technically neutral to bullish. But the indicators are deeply hesitant. The 14-day RSI is sitting at a perfectly neutral 52.03.
Neither overbought nor oversold.
Exactly. And the daily NCD is essentially flat at 0.01, so it's flashing a slight buy signal, but the momentum indicators are offering zero real conviction.
Right. If we connect this to the bigger picture, the stock is currently sitting above the 5-day moving average of $4.79, which shows immediate localized strength as day traders step in.
Yeah, they're riding the bounce.
Right. And right now, it is actively testing the 50-day moving average at $5.06 as resistance. Breaking through and holding above $5.06 is a critical psychological victory for the bulls. But, it doesn't change the overarching reality of the chart.
Because the long-term trend remains firmly, aggressively bearish.
Precisely. That 200-day moving average is looming way up at $7.34. The 200-day moving average represents the consensus valuation of the institutional market over the past year.
Right. So until the stock can climb all the way back up there and break through with heavy volume, any short-term surge is mechanically just a relief rally trapped within a larger structural downtrend.
Exactly. Every time the price approaches that 200-day line, bag holders who bought at the top sell their shares just to break even, which immediately kills the momentum.
Now, here is where I have to push back a bit, because I don't buy the way Wall Street analysts are choosing to rate this setup right now.
Okay, what do you mean?
The consensus rating is overwhelmingly a hold due to what they call structural uncertainty. We're talking about roughly 84% of analysts sitting on a hold, only about 11% saying buy, and 5% are outright bearish.
The numbers don't lie.
But look at their own price targets. The average target is $7.87, the median is $7, and the lowest bear target is $4. The stock is sitting at $5.15 right now.
Right.
So the median target is $7, which represents a massive percentage upside from $5, and yet 84% of them refuse to commit to a buy rating. If the short-term indicators are flashing green and the stock just surged past its 50-day moving average, why is Wall Street paralyzed with an 84% hold rating?
You think they're missing the boat?
I mean, are they missing the boat or do they see an iceberg? It feels like they are ignoring a fundamental operational turnaround because they are terrified of looking foolish on a stock that has burned people before.
Well, it isn't cowardice. It is a rigid adherence to risk management driven by completely different time horizons.
Okay, explain that.
What you view as a turnaround, institutions view as a temporary reprieve. You are seeing a standoff between two fundamentally opposed market participants.
The day traders versus the institutions.
Exactly. Day traders and swing traders are playing the momentum. They see the messy crossover, they see the bounce off the $3.81 floor, and they buy the technicals. But institutional investors, the ones who actually dictate these analyst ratings and move billions of dollars, they do not allocate capital based on a 5-day moving average.
No, they're looking at the balance sheet.
Right. They're looking at the fact that Snap has $4.14 billion in debt maturing in a hostile macro environment. They are calculating the liquidity runway against the threat of dominant competitors, not trading the daily chart.
And that analyst paralysis brings us directly to the core debate of this deep dive. Is the current price a rare bargain, an undervalued gem, or is it a carefully disguised value trap designed to catch retail investors?
That's the trap. When you're staring at that $5.15 price tag, your brain plays a very specific trick on you called anchoring.
Oh, yeah. You pull up the chart, you see that 52-week high of $10.41, and your brain immediately classifies $5.15 as a deep discount.
Exactly. You assume that because it was at $10 a few months ago, it fundamentally belongs at $10 and it's bound to return there.
Right. And you look at the bullish argument, Snap is trading at a forward PE of 10.48x. In the world of tech and social media, a multiple that compressed actively screams bargain. Well, if it can consistently hit profitability anyway.
But you have to separate the chart's history from the balance sheet's current reality. The market doesn't owe this stock a return to its previous highs just because you bought the dip.
Yeah, that anchoring bias is exactly how retail traders get lured into a value trap.
Right. A low forward PE is only a bargain if the earnings are actually going to materialize. If they don't, it is simply a distressed asset getting cheaper, and the structural headwinds severely threaten those future earnings.
So what are the actual downside risks here?
Well, user growth in North America, which is by far their most mature and lucrative advertising market, is stagnating. They are fighting an agonizing multi-front war.
Yeah, TikTok is just a juggernaut.
Exactly. They face the relentless algorithmic efficiency of TikTok pulling away daily user attention. And then Meta possesses infinitely more resources to simply copy Snap's most popular features and deploy them to billions of users instantly.
Plus, there's the mounting global regulatory scrutiny over teen safety. The operating environment is uniquely hostile right now.
And it's not just user attention, it is the mechanics of the advertising dollars themselves. When macroeconomic conditions tighten and the cost of capital goes up, corporate advertising budgets shrink.
Right, and when a brand's marketing budget gets slashed by 20%, they do not reduce their spending equally across all platforms.
Nope. They eliminate the experimental secondary channels entirely. They consolidate their remaining budget into the platforms that offer the absolute highest, most undeniable return on ad spend.
Which invariably means Google and Meta. So smaller platforms like Snap face an asymmetrical revenue drain during ad market downturns because, they are treated as discretionary ad spend, not essential infrastructure.
Exactly. And that defensive, shrinking posture perfectly explains why activist investor Irenic Capital has stepped into the ring.
Right.
Activist investors taking a stake fundamentally alters the trajectory and the timeline of the company.
Yeah, here's where it gets really interesting. Irenic Capital getting involved totally changes the calculus here. I mean, they aren't just a strict personal trainer stepping in to optimize a few corporate workflows or tighten up the engineering sprints.
No, they're a corporate repo man.
Right. They look at this company, see that heavily compressed 10.48 forward PE, see the underlying cash generation of the core ads business, and they realize the individual parts of Snap might be worth significantly more than the whole.
They do not care if Snap's augmented reality division succeeds in changing the world in 2030.
Not at all. They care about stripping the copper wire out of the walls today. They want to force aggressive cost-cutting, initiate stock buybacks, or actively shop the core business to a larger buyer right now to unlock immediate shareholder value.
They are looking to extract capital, not foster long-term technological breakthroughs.
Which could be a disaster for Snap's actual product roadmap. I mean, it might work, or the athlete might completely crack under the pressure of trying to fight heavyweights like Meta while starving on a diet.
That highlights the true danger of activist intervention in the technology sector. Trimming corporate fat is one thing, but if you cut too deep into a tech company's research and development, you destroy the actual muscle required to compete.
Yeah.
If an activist forces Snap to gut their AI lens improvements or their highly anticipated augmented reality hardware development just to temporarily boost the quarterly margins, they might trigger a brief spike in the stock price.
Sure, Wall Street loves a cost cut.
Right. But in the process, they completely hollow out the company's future competitiveness, ensuring it eventually dies to Meta and TikTok anyway.
So if we summarize the debate right now, the bull case rests on that improving free cash flow of $437 million, activist pressure to unlock value, and historically low valuation multiples.
And the bear case focuses on that crushing $4.1 billion debt load, being stuck in a massive long-term downtrend, and fierce competitor headwinds.
All of these conflicting narratives, the tension between the day traders buying the momentum and the institutions avoiding the debt, the friction between the activist investor demanding short-term returns and the engineers trying to build long-term hardware. It is all funneling into one massive, unavoidable bottleneck.
The earnings report.
Exactly. The immediate catalyst is the next earnings report, which drops on April 28, 2026. That singular event is going to force the market's hand.
It really is. The data in that report will either completely validate this recent 6.85% bounce and send the stock breaking cleanly through the 50-day moving average.
Or it'll crush the momentum entirely and send it spiraling rapidly back down toward that terrifying $3.81 algorithmic floor.
As we look toward that catalyst, it is vital to synthesize the dual timelines we've explored today. In the very short term, the technical momentum is undeniably present, and traders are actively capitalizing on the volatility.
But in the long term,
the perspective remains heavily clouded by an existential battle. Management is trying to fund genuine, cutting-edge AI and AR innovation to pull the company into the future, while simultaneously fighting the gravity of paying down $4.1 billion in debt.
It's a tightrope. And just a reminder for everyone listening, everything we discussed today was a natural debate based on market data. You have to do your own research, as this is not financial advice.
Right. But before we wrap up, we've spent this entire deep dive treating Snap as a social media platform desperately trying to survive a brutal ad market.
Which it is.
It is. But if we completely reframe the board, the long-term endgame looks entirely different. This raises an important question that fundamentally changes how you might view this asset.
Oh, what's that?
Meta and Apple have both openly struggled with the immense technical challenges and capital drain of building lightweight, consumer-ready augmented reality glasses.
Yeah, it's been a slog for them.
Right. Well, Snap actually holds some of the most advanced AR patents and specialized engineering talent in the world.
Wait, really? So you're saying...
I'm saying if the stock price drops just a little further, it might actually become cheaper for a titan like Meta or Apple to buy Snap entirely just to acquire that intellectual property.
Oh, wow.
They could buy the company, shut down the Snapchat app completely to eliminate the social media overhead, and simply write off that $4.1 billion debt as a massive one-time R&D acquisition expense.
That is wild. So when you look at Snap today, are you actually investing in a social media turnaround, or are you just buying a discounted hardware patent portfolio waiting to be swallowed whole by a tech giant?
Exactly.
Are you buying a company or a tech giant's future shopping list? That is definitely something to mull over. Think about that the next time you look at the chart. Thanks for joining the deep dive. We'll see you next time.